You paid it off. Maybe it took 30 years. Maybe you made extra payments when the kids left home. Maybe you refinanced once in your 40s to get a lower rate and then gritted your teeth and paid it down to zero. But you did it. The mortgage is gone. The bank has no claim on your house. You own it, completely, cleanly, free, and clear. That house is not just a place you live, it is the single largest asset most Americans have at retirement. It is the financial foundation under everything else. It is the thing you plan to leave to your children, or draw on carefully if things got hard, or simply live in for the rest of your life without a payment to anyone. And then someone makes you an offer. Maybe it's a lender. Maybe it's a financial advisor you trust. Maybe it's an advertisement that finds you at exactly the right moment. When the roof needs replacing, when medical bills are stacking up, when your retirement accounts didn't perform the way you hoped, when you just need breathing room. The offer sounds reasonable. Take out a loan against the equity you've built. Use the money for whatever you need. The terms look manageable. The monthly payment looks affordable. You sign. What you did not read, what almost no one reads carefully enough, is the clause buried inside that loan document. The one that changes the deal entirely under certain conditions. The one that can accelerate your loan balance, strip your equity faster than you ever imagined, or hand your home to a lender years before you ever planned to leave it. You didn't refinance a paid-off home. You handed a financial institution a legal claim to the most important thing you own. And after 62, that mistake can be almost impossible to undo. Here is the trap laid out plainly. When you own a paid-off home at retirement age, you have something extraordinarily valuable, not just the asset itself, but the freedom that comes with it. No payment, no lender, no obligation. If your income drops, if your health changes, if your spouse dies, your home absorbs none of that shock. It just stands there, solid, paid for, yours. The moment you take out any new loan against that home, whether it's a traditional cash-out refinance, a home equity loan, a home equity line of credit, or a reverse mortgage, you have introduced a legal claim back into the picture. And every one of those products contains language that, under the right circumstances, can be weaponized against you. Most retirees focus on the interest rate, on the monthly payment, on how much cash they can access. They do not read the default clauses. They do not read the acceleration provisions. They do not read the occupancy requirements, the insurance mandates, the property maintenance obligations, or the conditions under which the loan can be called due in full. And after 62, those clauses carry consequences that are categorically different from what they would have meant at 45. Because at 45, if something goes wrong, you have time. You have income, you have options. At 70, if a lender calls your loan due for any reason, your options may be almost none. This is why financial advisors who specialize in retirement planning will tell you something that sounds almost radical. The paid-off home is sacred ground. Protect it. Before you borrow against it, understand exactly what you are agreeing to, because the clause that destroys your equity is almost never the one you were shown at the closing table. Let's go into the 3 layers of this danger, because each one operates differently. Each one catches a different kind of retiree. And together, they explain why this mistake is so common and so catastrophic. Layer 1. The acceleration clause in a traditional cash-out refinance. A cash-out refinance replaces your existing mortgage, or in your case, fills the place where a mortgage used to be, with a new loan. You receive a lump sum. You owe a monthly payment. So far, that's what most people understand. What most people don't understand is what happens when you can't make that payment. Because at retirement, income is fixed. Social Security doesn't grow quickly. Pensions don't flex. Investment accounts can drop in a bear market. And if your health deteriorates, if you have a hospitalization, a long rehab stay, a serious diagnosis that interrupts your daily financial management, a missed payment can trigger the acceleration clause. An acceleration clause means the lender can demand the entire remaining loan balance immediately, not next year, not through foreclosure negotiations, immediately, or within a very short legal window. And if you cannot pay the full balance, the lender proceeds to foreclosure. Your paid-off home, the one you built over 30 years, goes to satisfy a debt you took on for a kitchen renovation or a medical bill or a child's emergency. The clause is standard. It is in almost every mortgage document. Most borrowers at 45 don't worry about it because they have 30 years of income ahead of them. Most borrowers at 70 don't notice it because no one points to it at closing, but it is there. And after a certain age, its presence is not theoretical. It is a loaded mechanism. Layer 2, the HELOC freeze and the demand note. A home equity line of credit seems more flexible than a cash-out refinance. You draw what you need when you need it. You pay interest only on what you've used. It feels controllable. Many retirees choose it specifically because it feels less permanent, but a HELOC is not a fixed arrangement. Lenders have the right built directly into the contract to freeze your line of credit, reduce your available credit, or demand repayment if your home value drops, if your credit profile changes, or if the lender decides the risk landscape has shifted. In 2008 and 2009, millions of Americans watched their HELOCs get frozen overnight, without warning, in the middle of projects they'd started, plans they'd committed to, financial situations they'd restructured around the available credit. After 62, a frozen HELOC is not just an inconvenience. It can be a financial emergency. If you drew on it to pay for home modifications, for medical expenses, for living costs during a lean year, and then the lender freezes the remaining balance and demands repayment of what you've drawn, you are now managing a debt you cannot easily escape against a home that is your primary security, with income that has no room to absorb a sudden obligation. And the demand note inside a HELOC can be more aggressive than a standard mortgage. Because a HELOC is a form of revolving credit, not a term loan, the repayment terms at the end of the draw period, when the loan converts to a repayment phase, can produce payment increases that retirees on fixed income simply cannot sustain. Layer 3, the reverse mortgage occupancy trap. The reverse mortgage is often marketed as the solution for retirees who want access to home equity without a monthly payment. No payment while you live in the home. The bank collects when you sell, move, or die. It sounds like a reasonable tool for specific situations, but the occupancy clause inside a reverse mortgage is where families get blindsided, and it happens at the worst possible moment. A reverse mortgage requires the borrower to occupy the home as their primary residence. If you leave the home for more than 12 months, for any reason, the loan can be called due. If you enter a nursing facility, if you have a stroke and move in with your daughter during a long recovery, if both spouses are on the loan and both leave for an extended health-related stay, the clock starts running. And if you cannot return and the loan is called, your heirs have a very short window, typically 6 months, sometimes a year, to sell the home or pay off the loan before the lender takes possession. Families routinely discover this in the middle of a medical crisis. A parent has been in memory care for 14 months. The reverse mortgage lender sends a notice. The family is managing a medical situation, a grieving process, and now a foreclosure timeline simultaneously. The equity, the inheritance, the legacy, the thing your parents spent their life building, evaporates in a matter of months because the occupancy requirement was never fully explained at the closing. Let's put two retirees next to each other because the numbers here tell the story better than anything else. Both are 68 years old. Both own paid-off homes worth $380,000. Both need $60,000, one for home repairs and supplemental retirement income, the other for similar reasons. The first retiree, call him Dennis, takes out a cash-out refinance at a 7.2% interest rate, 30-year term, monthly payment of $408. It feels manageable on his Social Security and small pension. 4 years later, at 72, Dennis has a health event, a serious surgery, a long recovery, 3 months in a rehab facility. His finances fall behind. He misses 2 payments. The lender invokes the acceleration clause. Dennis now owes $57,000 immediately. He cannot pay it. The bank begins foreclosure. The home he paid off, the home he lived in for 31 years, is sold at a foreclosure auction. Dennis walks away with a fraction of its value after legal costs and the loan balance are satisfied. The $380,000 home produces less than $90,000 in proceeds for Dennis. His children receive nothing. The second retiree, call him Warren, Consults with a fee-only financial advisor before making any move. The advisor runs the numbers. She explains the acceleration clause, the occupancy risks, and the long-term cost of debt in retirement. Together, they identify an alternative approach, a structured drawdown from Warren's IRA, timed carefully to manage tax exposure, combined with a smaller, short-term personal loan for the immediate repairs. Warren keeps the home free and clear. He has no lender with a claim on his property. When Warren passes away at 81, the home, now worth $510,000 after years of appreciation, transfers cleanly to his two children. The full value, no payoff, no lender, no foreclosure clock, same starting point, same need for cash, completely different endings. Dennis lost his home. Warren left his children $500,000. The difference was one conversation before signing anything. Here is what you need to do if you own a paid-off home and are considering borrowing against it. Stop before you sign anything. Not pause, stop. Treat this decision with the same gravity as any irreversible financial choice, because after a certain age, it may be exactly that. Read every default clause in the loan document, not a summary, not the highlights your lender walks you through, the actual contract language. Specifically, what triggers acceleration? What happens if you miss a payment? What are the occupancy requirements? What maintenance or insurance conditions could put you in default? Consult a fee-only fiduciary advisor, not the lender. The lender has a financial interest in closing the loan. A fiduciary has a legal obligation to act in your interest. Those are not the same conversation. Explore non-debt alternatives first. A structured IRA withdrawal strategy, a Roth conversion timed across low-income years, downsizing, assistance programs for seniors covering home repair costs. Many retirees take on debt because they don't know the alternatives exist. If you are considering a reverse mortgage, involve your heirs in the conversation. They will be the ones managing the occupancy clock if you enter a care facility. They need to understand the timeline, the payoff obligations, and what happens to the home if the loan is called due while you are in memory care. This is not a comfortable conversation. It is a necessary one. Retitle and review your estate plan in the context of your home equity. If the home is going to be a primary inheritance for your children, make sure your estate documents reflect that. Make sure the home is not exposed to claims from loans, from Medicaid estate recovery, from creditors that could intercept what you intend to pass down. And if you have already refinanced a paid-off home, review your loan documents now. Know exactly what your default triggers are. Know what your balance is. Know what your options are if your income changes. Having a plan before a crisis is incomparably better than discovering the clause when the letter arrives. The paid-off home is one of the most powerful financial positions a retiree can hold. It represents not just value, but freedom. Freedom from payments, freedom from lender demands, freedom to pass something real and whole to the people you love. The financial industry has built an entire product ecosystem designed to extract that equity from you, one transaction at a time. Refinances, HELOCs, reverse mortgages, equity sharing agreements. Each one is packaged to look like access. Each one actually delivers obligation. And inside each obligation is a clause, buried, standardized, rarely explained in plain language, that under the wrong circumstances becomes the mechanism by which you lose the thing you spent your life building. You earned that paid-off home. It is yours. The best thing you can do with it is protect it like the irreplaceable retirement asset it is. If this warning found you before you signed anything, you are still in a position of strength. Use it. Save this video. Share it with someone who owns their home free and clear and is thinking about borrowing against it. They may not know what they're about to agree to. Subscribe, because these are the warnings written in the fine print. The ones designed to be missed, the ones that matter most when the letter arrives and it's too late to ask the question you should have asked at the closing table. Your home is your legacy. Protect it like one.